In this video, I want to show you how I take my economic risk score, which is my own assessment of where we are in the business cycle, and translate that into an actual portfolio allocation in terms of my investments. For those of you who are new to my channel, my name is Jared Ayres. I am a CFA charter holder, and I have created this channel to share with anyone who's interested my own investment strategies and thought processes with respect to investing in the broader markets. I have found that the way I think about investing is a little bit different, but then again, my returns are also a lot better than the market can usually produce for me. So I hope you enjoy. Now, before we jump into this, I do want to say that everything I am presenting in this video are my own opinions, my own thoughts. I don't want anybody to mistakenly take anything I say as advice or a recommendation. Always consult a financial advisor on any investment decisions you may be making for yourself. The ones I'm presenting in this video are really those that I've constructed for myself, my own circumstances, my own risk tolerance, and all those types of things. So please make sure you do consult a certified investment professional before you try to jump in and do these things on your own. Now, let's get into the actual nuts and bolts of what I want to present today. So I did want to kick off this video with a little bit of a review on the risk score itself and how we got to that. So I'll link back to the video where we actually detailed the mechanics on how we calculate the risk score in the description, as well as a link at the end of this video for you to go back to as a reminder. But if you recall from the prior video, we did the 4.1 was the risk score that we were showing for the end of year 2018 total risk score. So obviously with the 13 indicators we were using and the various weightings of the various attributes relating to those indicators. So that is, just keep that in mind as we go through this video. The other thing I just want to review as well is just the asset classes. So I did cover this also in a previous video, and I just want to remind you kind of what or how I view asset classes, the buckets I put them in, and then a little bit of detail as to what I think would be included in those buckets, just to give you a little bit of perspective on how I think about these asset classes before we actually go into the allocation to these asset classes. So the 5 buckets that I most readily consider in terms of asset classes and allocations to them: equities, number 1, bonds, alternative investments, which in my case I focus on managed futures, precious metals, which I focus on gold, and cash. Now again, these are my own asset classes that I believe or I think about. I mean, there'll be people that don't think gold is an asset class, there'll be people that don't think cash is an asset class, but as far as my whole portfolio is concerned, these are the asset classes I most readily think about. So just to go into a little bit of detail on the equity side, some of the equity types or buckets that I may consider: developed market equities, so thinking about North America, Japan, Europe, the more developed Australia economies and their equity markets and equity securities. Emerging market equities, which could be any of the BRIC nations, so that's Brazil, Russia, India, China, are the most, I guess, prominent or most talked about emerging markets. Real estate is in the equities section only as it relates to publicly traded REITs. So these are real estate investment trusts. These assets, when they are publicly traded, I often find behave very much like any other equity security, even though they may have assets within them that do perhaps display different types of attributes than, say, traditional business type equities like a publicly traded company stock. Private equity, same sort of thing. Private equity would be considered a different in a different asset class, except for those firms that are also publicly traded. So again, because they behave, or private equity securities in the public markets behave like any other publicly traded equity, they're in this bucket as well. So just to give you perspective on how I think of these. On the bond side, the debt side, there are, I believe, times when you'd want to own different types of bonds, whether it's different types in terms of maturity or duration, as well as different grades of debt instruments. So whether it's the riskier side of debt or bonds, or the more secure side. So from time to time, short-term maturity bonds being sort of the a broad sort of basket of short-term bonds if interest rates, for instance, are rising, just to give you protection. Developed market long-term government bonds, developed market short-term government bonds, investment grade long-term corporate bonds, the equivalent on the short-term side, and then any high yield or emerging market bonds, which would be considered higher risk in nature. So these would be potentially the buckets that I would think about when considering how and perhaps the timing of allocation to the bond asset class. So alternatives is the next one. Real estate, again, as it relates to assets that are not publicly traded, so privately owned property would fit into the alternatives category, and that's really because it does, in the private markets, display different properties, different reactions to markets than the publicly traded counterparts. Commodities, really, I think about these as futures. So, and commodities being sort of non-precious metal type commodities. So, oil, lumber, think about the CBOE type commodities that are traded out of Chicago. Private equity, again, the non-publicly traded firms. So obviously these are only available to high net worth individuals usually, but the two types of private equity firms that would fall into that bucket, of course, are the leveraged buyout firms versus the venture capital firms, which are structured quite a bit differently in terms of how they operate. Managed futures is also in the alternatives category. That's really the one that I focus on in terms of my own portfolio, just because of its low correlation in terms of behavior compared to, say, bonds or equities, certainly in challenging times. And then of course collectibles, so wine, art, classic cars, whatever you want to put in that category is kind of the other catch-all that could fit into the alternatives asset class. Precious metals is, like I said, something I consider an asset class. Many consider this not to be an asset class. I look at it as more of a hedge. So for me, if things are really, really looking dire, I will move a portion of my portfolio potentially into precious metals, primarily gold, as a hedge against sort of that, potential flight to safety mentality that may grip the market. So I see it as a trade, not a long-term investment. I don't believe that you want to be in precious metals for the long term, because as many people will mention, over the long term, and quite rightly so, they do not actually perform very well at all. And finally, cash. Again, some people may not believe that is an asset class, but to me, cash is always something you want to have on hand unless things are absolutely amazing in terms of prospects in the economy. So, and obviously it will depend on also what your situation is and whether you need different currencies available. So I'm just listing out the different currencies obviously here: US dollars, Canadian dollars, Great British pounds, euros, and Japanese yen, just to name a few from the developed market anyway. So those are kind of the overall asset classes I think about. So this is sort of my little matrix in terms of, my risk score, which we kind of shared at the beginning there, was kind of 4.1 at the end of 2018. So this kind of helps me think about, okay, so if my risk score, if my assessment of the business cycle, falls anywhere in that range between 0 and 10, here are the corresponding weightings of my asset classes that I would, want to move towards, given different assessments of the broader economy and the business cycle. So just as a note, on the asset class side, the threshold percentages in each asset class are equivalent to the minimum score in that min to max range for my economic risk score. So in other words, at 8.9 on the second one there, I would be at 95% equities, 5% cash. Similarly, at a score of 5, I would be 60% equities, 35% cash, 5% gold. So that's kind of what this corresponding minimum is, what these percentages relate to. So once I have a framework for the asset class allocations that correspond to the risk scores, then I can kind of come up with my own assessment. So like I mentioned, in our end of 2018 risk score was 4.11, so that puts it in a range of this level, so between 3.7 and 5.0, obviously a little bit higher than the 3.7, kind of 40% equities, 10% bonds, 40% cash, 5% gold, 5% futures. So if we work that out, and where that falls between that 3.7 and that 5.0, score of 4.11 equals equities at 46%, bonds at 7%, cash 38%, gold 5%, and futures 3%. So that is, and those are obviously rounded numbers, but that is sort of my guideline as to, okay, so my assessment of the business cycle is this, and the proposed asset allocation is as it is here laid out. So when I look at this risk score allocation to the different assets, I want to make a decision as to when I want to start moving in towards these different weightings. I don't necessarily want to hit the sell button right away. I want to move towards these. So for me, I'm looking at what kinds of positions I have in equities, which ones are up. Maybe it's time to take some profits out of some of them, which positions perhaps are down, and whether or not the fundamentals in those positions are still sound, or whether they've deteriorated to the point where I need to make a call and perhaps exit those positions. On the bond side, maybe I need to look at what interest rates are doing. Are they going up? Are they going down? Are they flattening? And does that mean that maybe there's an opportunity to move into or out of different duration type bonds, or bonds with different risk profiles? So those are things that you do want to consider, at least I want to consider, before I go ahead and begin moving around my assets to match the allocation that my risk score has told me I need to be targeting. But it certainly helps me understand throughout the noise what I should be doing based on my own analysis. So that to me is probably the most helpful reason for this type of framework, and I can sort of go along and not really worry about what other people are saying. I can kind of create my own guide and map as to what I should be doing. It just gives me a much better comfort over my decisions, and quite frankly just helps me sleep at night. So that was really what I wanted to share with you, so hopefully that was helpful. And if you have any questions, obviously feel free to ask. So hopefully you found that video helpful or at least interesting. As usual, please leave any comments you feel that you want to leave, any questions. Perhaps let me know how you allocate your own portfolio across asset classes. Like I said, I will provide a link to the video where I laid out how I calculated my economic risk score, and also include that in the description. So if you haven't already and you'd like to see more, please don't hesitate to subscribe and or like my video. And any feedback you have, I'm always open as usual. So appreciate you tuning in, and hopefully we'll see you again soon.